There are three major risks to a stock's dividend payout ratio that will mean the difference between solid returns or big losses. In this video, I'll not only explain the dividend payout ratio, I'll reveal those three payout ratio traps and how you can be a better investor. We're talking dividend payments today on Let's Talk Money.
Beat debt.
Make money.
Make your money work for you.
Creating the financial future you deserve.
Let's talk money.
Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to everyone in the community. Thank you for taking a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. So we're in the middle of a series of videos on dividends, and anyone in the community knows I'm a huge fan of these cash flow stocks. Research upon research has shown that dividend stocks tend to do better than other investments. Probably the most famous, we see here research by the Ned Davis firm that over nearly 4 decades, dividend stocks return an annual rate of 7.2 to 9.5% compared to that return of just 1.6% on stocks that didn't pay a dividend. But one of the most important concepts in dividend investing isn't well known by a lot of investors. Now, this metric goes to the very heart of a company's dividend payment and its ability to keep paying or even growing that dividend. Ignore this measure and the risks that we'll talk about and just wait for that stock to collapse, because it will happen if you don't know what to watch for. I'm talking about the dividend payout ratio, and this is simply the percentage of the company's profit it's paying out as a dividend. Now, I'll show you 2 ways to calculate the payout ratio in a moment, but it's basically just the dividend divided by the company's earnings or its net income. Now, if we look at the 2 sides to that payout ratio, you'll see how important it is and maybe even start to see some of the risks that we'll talk about. Dividends paid by a company are a big responsibility. It's a commitment not only to make current payments, but most investors see it as a commitment to make those future payments as well. All you need to do is look at any company that's cut its dividend payment and watch the stock price to know that how important that forward planning is for cash flow and for the company. And the other side of that dividend payout calculation is just as important: the company's earnings, its profits. Stocks are an ownership on those earnings, so this is directly related to a stock's value and its price. Now, I want to show you 2 simple ways to calculate the dividend payment ratio, but first I need your feedback on something. I asked in an earlier video if you wanted to see more dividend or more growth investing videos, and the response was overwhelmingly to dividends. So I'm planning more on how to invest in dividend stocks, but what are the ideas that you want me to cover? What are the dividend stock measures or the strategies that you want to hear about? So scroll down and let me know in the comments below this video about those dividend investing ideas. Now, the payout ratio is super easy to calculate in a couple of different ways you can do it. Some websites or even a company's financial statements may tell you the dividend payout ratio, but it's so easy to calculate it on your own that I like to double check the numbers anyway. The first way to find that payout ratio is just go to a company's financial statements. So here we are on the Apple stock page on Yahoo Finance, and we'll click on this financials in the menu. This is going to take us to the 3 financial statements. The income statement shows the sales and profits of a company over either a year or 3 months. The balance sheet shows us the company's assets and debts at a point in time, and the cash flow statement shows us the actual cash in and out of the company over that year or 3-month period. So these 3 statements are something that we've talked about on the channel before, and you know I'm a big believer in using the statement of cash flows rather than the income statement. Most investors get caught up in those sales and the earnings on the income statement. That's what's reported most in the media and by the press. But these are all manipulated by management to make the company look as profitable as possible. It's much harder to bias those cash flow numbers because it's actual cash accounting. And in fact, this is where professional analysts spend most of their time, looking at those statement of cash flows and doing cash flow modeling. Anyway, so we'll first click over to this cash flow statement and make sure it's set to annual here. Then we'll come down here to dividends paid. So this is the annual amount Apple pays out as dividends in this year, and this number we see is in the billions of dollars. So the company paid out over $11,561 million in dividends this last fiscal year. Now we'll scroll back up and click over to the income statement, which is going to show us that net earnings for the year. Here we'll look for the net income from continuing operations, or the net income available to shareholders. We see that it was $53,394 million. So we'll open our calculator here, and if we take our $11 billion in dividends paid and divide it by the $53 billion and change in net income for the same period, we get a dividend payout ratio of about 22% for Apple during that year. Now, this payout ratio is going to fluctuate a few percent from year to year, so you should really take an average over a few years, but either way gives you a good idea for that comparison. Another way to find the dividend payout ratio, and it really makes no difference which way you use, is to do it on the per share basis. So here we are on the Apple stock page again, and we see that Apple pays a $2.92 a year per share in dividends. Understand this is a forward dividend, so the current quarterly dividend times 4. Now we need the per share net income or the earnings, so we scroll down to this earnings graphic and we see each of the last 4 quarters. We can use this method anywhere you find per share dividends and earnings, so not just Yahoo, but the site makes it really easy to find. First, we'll add up each of these quarters' earnings to get the full year number, and we get an earnings per share of $12.16 over the last year for Apple. Then we just take that $2.92 in dividends and divide by the earnings for a dividend payout ratio of 24%. Now understand this is going to be slightly different from that other method because you're using the current dividend times 4. So dividends over the next 4 quarters and then using that last 4 quarters in earnings. Now technically you should find the last 4 quarters in dividends, but this is going to give us an estimate that's as close as we need for comparisons. Now that we have the payout ratio for a stock, I want to reveal 3 risks to looking at this that you simply can't ignore. These 3 ideas are going to be critical to using that dividend payout ratio and picking the best stocks from it. First though, if you're liking the video and think it's some useful information, do me a favor and tap that thumbs up button or consider sharing it with someone you know. The first risk you want to watch out for in that payout ratio is a company paying out too much of its earnings as a dividend. Now, I know we all love dividends and it's great seeing that high yield, but there is a trade-off that you need to watch. A company paying out most of its profits as a dividend isn't going to have much left over to grow the business, to grow those earnings in the future. Now we know that the share price of a company is based on those future earnings. That's what you're investing in, is a share of those future profits. If earnings aren't going to be increasing, or worse yet, they might decrease because the company hasn't spent enough to stay competitive, then that stock price could suffer. Obviously, it does no good to collect that juicy 10% dividend yield on a stock if the share price falls by 15% during that year or over the same period. Of course, the question becomes, how much of earnings can a company pay out before it starts limiting its growth? For this, you can start by just comparing it to the dividend payout ratio from other companies in its industry. Now remember, and this is extremely important in a lot of investing ideas, you always want to compare a company with others in its industry, not just with all the other stocks or other companies outside the industry. So here we see a few industries and their payout ratios. Now this is data collected by Professor Damodaran of the Stern School at NYU, a great resource for investors, and you can see how much some of these industries differ on their payout ratio. You've got household products and utility companies that pay out the majority of their earnings, some even more than their earnings as dividends. Compare that to you've got the biotech drug industry that almost pays no dividends at all. Now think about this from a management perspective. The growth prospects are more limited in older industries like household products or in regulated ones like utilities. Debt is very easy to come by for these industries right now with stable cash flows, so they can pay out lots of dividends and then just borrow if they need more money. On the other hand, industries like biotech and semiconductors, it's all about reinvesting in research and development to create new products. Debt is more expensive because sales and profits are more volatile, so these companies need to keep more of their cash flow, more of their cash back instead of paying it out as dividends. This is why you absolutely must compare companies with others in their industry. This goes for not only comparing the dividend payout ratio, but other metrics like price to earnings, dividend yields, and sales growth as well. So comparing that payout ratio with the industry average, you can start to do some analysis here. If they're paying out more, is it going to be at the expense of that growth? If they're paying out less, does that mean that the company is going to grow faster, or is it an opportunity to increase that dividend? You can also compare a company's payout ratio with its own history, so going back to look at how the payout ratio has changed and how that's affected sales growth for the company. Now, the second place you need to look when you're looking at dividend stocks and the payout ratio is whether the payment is supported by cash flows. Dividend payments in a share buyback program can be a big drain on cash and can turn into a big problem if that cash flow evaporates. In fact, this is what happened to Warren Buffett in his IBM investment, one of his worst investments he's ever made. Buffett started buying shares on IBM in 2011, seeing a cheaper share price and chasing that high dividend yield. The company also had a huge share buyback program that was boosting its earnings per share over the period. The problem was, and for this we look at that statement of cash flows again, it was paying for all of this with lots of debt. If we go down to where it says common stock repurchased and dividends paid on that cash flow statement, we see that IBM was burning through about $18 billion in cash through the dividend and buyback each year. Now you look a little further down to where it says free cash flow. This is the cash generated by the business, that operating cash flow, and minus the capital expenditures, which is the cash invested in equipments and other things to keep the company running. So this free cash flow is a measure of about how much cash is left over after reinvesting enough to keep the company stable, and you can see that it was well under $18 billion for all 5 of these years. So IBM was spending all this cash buying back its own shares and paying out that dividend, and it was paying for it by just piling on the debt. If you look at the difference between the debt issued and the debt repayment, the company borrowed more than $24 billion over those 5 years to pay for all of this. So this is something that obviously couldn't go on forever. The company's sales just weren't rising fast enough. Interest payments were ballooning, and the stock price ended up tumbling from a high of $215 a share in early 2013 to $150 per share towards the end of 2017, when Buffett just finally gave up on the investment. This is something you have to watch, especially in those dividend stocks with high payout ratio. You need to check back each year into that statement of cash flows. Look at how much cash the company is paying out in dividends in that share buyback program. Then look at where the money is coming from. Is it coming from cash generated by the business, that cash flow from continuing operations, or is it coming from new debt? Is the company still spending as much as it has in the past on capital expenditures, that money reinvested to keep the company competitive and to grow it from there, or is it cutting back in order to meet those cash payments? Our third risk to remember when you're looking at that dividend payout ratio is you can't apply this to real estate investment trusts, those REITs, or to master limited partnerships, MLPs. Now, we talked about this in a prior video on those 2 special types of companies. REITs hold and manage real estate and then pay out the majority of their cash flow to investors. MLPs hold energy assets like pipelines and storage facilities. Both get a special tax break by paying out most of their annual income as dividends, so these are some of the best dividend yielding stocks you can find, with a yield 3 times the market average. The problem is that these 2 types of companies have so much in depreciation expense. That's the accounting trick that they use on their income statement. They have these properties or these pipelines and get to take a certain amount of the value off each year to deduct it from their earnings. That makes their earnings, that net income, look artificially low because the deduction isn't actually cash going out the door. So if you take the dividend payment divided by this artificially lower net income for these types of companies, you get a payout ratio of over 100%, making it look like they're paying out more than they have, and in that danger scenario. Now, I'm going to link to that prior video where I explain this in more depth, but with these MLPs and REITs, you have special earnings measures that you use instead of that net income. For REITs, you use what's called the funds from operations, or FFO. For MLPs, you use what's called the distributable cash flow, or DCF. Now, I'll show you how to find both of these next, but they're always available on a company's annual reports as well, so you don't necessarily have to calculate them yourself. Now, just like with using that net income when we calculate the dividend payout ratio, you use these 2 measures, the FFO for REITs and the DCF for MLPs, to find out how much of a company's core earnings it's paying out as dividends. You can then compare that to similar companies and to the company's own history to analyze if maybe it's paying out too much or could even increase that payout. So here's the table to find the DCF for master limited partnerships. And again, don't get freaked out because this is always provided to you in the reporting. To find out how much money the company has available to distribute, you take the cash flow from operations, and this is all going to be found on the statement of cash flows, and you remove any spending on capital and income from non-controlling interests. That gives you sustainable DCF, which is what the company can return to investors and still keep the operations running smoothly. Now, while sustainable DCF is a better measure, most people just use this DCF as reported because it's sometimes the only number reported by a company. To get to DCF, you just add back that income from non-controlling interests as well as that working capital reported. Now, the big one here is adding back this proceeds from asset sales. This is technically proceeds so that the company can return to investors, but a company can't be forever selling its own assets and still keep the business running. So that's why we use that sustainable DCF when it's available. So you see here the coverage ratio for a group of MLPs, and that averages around a DCF that's 1.2 times the distribution. This means the company has cash flow about 20% higher than what it's returning, but you also see that some companies here are saving back more or even much less. For a real estate investment trust, FFO is very similar to that DCF that we saw with MLPs. Now, you take the reported net income of a REIT and add back depreciation, but then minus out any gains that they made on property sales. Those property sales are a source of income, but again, not something that a REIT can do forever and expect to stay in business. So investors also look at the adjusted funds from operations, this AFFO, which takes out those capital expenditures. Now CapEx here is money that a company spends to keep its properties in good shape, so maintenance spending and other things like that. Remember, the idea is just to find out how much cash the company has available to distribute without cutting into money it needs to run that business. I'll link to that video in the description below and click through because I spend more time walking through these two measures. REITs and MLPs are some of the best investments you can make, but you need to know how they differ from regular stocks. We're about halfway through our 2019 Dividend Stock Challenge portfolio, and the stocks are just blowing up. This portfolio is up over 24% so far and beating the market by nearly 10%. I'll leave a card here in the corner and a link in the description as well to see how we picked dividend stocks for that portfolio and how you can join the challenge. We're here Mondays, Wednesdays, and Fridays with the best videos on beating debt, making more money, and making your money work for you. If you've got a question about money, just subscribe to the channel and ask it in the comments below. We'll make sure you get an answer in a future video.